Hello, and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. By now, you'll all know that we're both tax partners in RSM's London office, and this podcast is aimed at private client professionals, fellow tax practitioners, bankers, lawyers, trustees, etc., who have a focus on private clients and private wealth. Throughout these COVID times, I found that I'm stuck at home, I'm working, but really, I'm really very bored. I don't go out, I don't go to the pub, I don't see many people face to face. What can I do?
I'm possibly not the best person to advise you on that one, because what you've just described is my ideal lifestyle. The whole thing about working from home, as you know, my favourite sort of weekend involves not speaking to or seeing any other human beings for 48 hours before I'm forced to go back and engage with the world again. So what you're describing...
Oh, well, that's not much help to me.
No, I'm afraid not. All I can say is welcome to the club, and being stuck on your own is a good thing.
Anyway, let's move on. I think let's talk about tax, because it'll be more exciting than being in your club.
Well, I have a question for you this week, which is something that I genuinely just struggle to get my head around. One of my clients has been in touch with me, as happens very frequently, to say that he's planning to buy a new rental property, residential property to rent out, and to discuss the question of, how to hold it and all those things. Setting aside the question of how should you hold it, which we can look at in a second, my first question for you is, I just don't get it. I don't get why people are so keen on holding residential property as a sort of an investment asset class, because it just seems to me that it's such a lot of hard work. You've got the risk that your tenants will disappear and won't pay your rent. You've got the roof caving in and having to pay all the money in repairs. You've got awkward agents, you've got dodgy tenants, the whole thing. It seems like so much effort to me. So explain, why is it, Rachel, that people do this?
I think people do like property as an asset class, and I think in comparison to just a share portfolio, which is probably the most widely held asset class for investments, with the property, you can physically see it, you can touch it, you can see it really exists, it's there. And I think that in itself is is one of the reasons why people like property over other investment assets. I think there are some other reasons as well. There's certain perception that property prices rise year on year on year. I think many of our viewers or listeners will obviously remember 2008, when real estate dropped in value quite dramatically. But on the whole, property does seem to have, and I'll go back to say it's a perception, that it doesn't suffer those roller coaster ups and downs that we see in the FTSE, for example. I have come across some statistics which suggest that between 1999 and 2019, so a period of 20 years, residential property prices in the UK have grown about 200%. If you're our age, I think, if they're shaped by the period in when you first bought a house. So for me, that was when prices were rising. But I know when you and I have talked about things in the past, you've mentioned that it wasn't the same for you because you went into a period of negative equity.
It was definitely the case that when I bought my very first property, a basement flat in Plymouth, which immediately lost about 25% of its value and remained in negative equity for 4 years after I bought it. So maybe I am a little bit biased.
Yeah, and I also think if you go back quite a number of years, obviously the investment landscape was very different to what it is today. But remember, people actually didn't invest in shares in the same way that they do today. The pre-runner to the ISA, or the first one, because there's been a couple, haven't there, was the personal equity plan, the PEP, and that was introduced in 1987. And I would say, although I've got no evidence to back this up, you know, PEP was introduced that, you know, the regular person, that, you know, your normal person first started to buy shares in any meaningful way. And I expect that's also had an impact on how everyday people just view investments or property, and they do think of them very differently.
Okay, I mean, I take your point on the things like the 200% increase in value, but I don't think you're ever going to convince me to invest in bricks and mortar compared to stocks and shares. But moving on and pretending that I was going to buy a rental property, and especially we're talking here residential, I think.
Yeah.
There is very much these days, I think, a choice to be made between personal ownership and ownership through a company. Historically, for residential property, most of the time it was being held in personal name, and I think the main reason for that was because of the availability of tax relief on interest. So you will get tax relief on the interest you're paying, which could offset your rent. Effectively, you've got tax relief at your highest tax rate, so 40 or 45% tax relief available. And for a lot of buy-to-let purchasers, that tax relief, I think, is what's actually allowed them to fund their purchases, because it meant that the ongoing cost of financing the loan was that much lower. As we know, from April this year, relief on borrowing for individuals is restricted to basic rates, so you can only now get tax relief at 20% on any interest paid in relation to rent. So the choice between borrowing and owning personally compared to borrowing and owning through a company is now 20% tax relief on interest personally, or 19% tax relief in the company. So essentially that goes away. So what else might be a reason why might I think about a company compared to just simply putting things in my own name when it comes to rental property?
Well, of course, borrowing isn't the only consideration. Let's think about the rental income. If I'm holding my property through a company, that company is going to pay corporation tax at 19% on the net rental income. Whereas, of course, if I own the property personally and therefore receiving the rent personally, my income tax bill is going to be up to 45%, depending on the amount of other income I have. Therefore, the greatest net income is going to be provided for by using a company, and you can then, or the company can then use this to reduce the debt that it has taken out in order to purchase the property. On the other hand, if I'm the individual and I need that excess or extra income to, for my own use, whatever that may be, how do I get it out of the company? I've got to actually have the company pay me a dividend, and that dividend is itself then taxable on me. So you have got that differential in tax rates on income, and also that differential in how you're actually going to be able to use the profit. And I think we've also got to look at the acquiring of the property as well. In recent years, or perhaps even not so recent years, stamp duty land tax in England has risen quite a bit. And nowadays, if you buy via a company, you usually pay higher rates of SDLT than you would do if you buy a property personally. And you've got the same issues, and we should point this out, of course, that stamp duty land tax only applies in England. In Wales, it's the land transaction tax, and in Scotland, it's the land and buildings transaction tax. So they achieve the same thing, but they're called something different, and they have slightly different rates and bands.
So the company is generally more expensive as an upfront cost, you're saying, from that stamp?
I think it is. Well, it is. Yes, we can see that. Yeah.
I mean, thinking about it at the other end of the spectrum, when we come to sell the property, there are savings from having a company, of course, because if the company sells the property, you're paying corporation tax at 19%, whereas if you do it as an individual, you have a 28% capital gains tax, because we're still at 28% for residential property CGT compared to 20% for capital gains tax on anything else.
Yes.
You've also got the option, I guess, of selling the shares in the company and not paying, and the purchaser not paying the stamp duty. They'll pay stamp duty on shares at 0.5% rather than on the property itself. So that might be a factor as well. Although, maybe slightly arguing against myself, if we do sell the property out of the company, yes, I've got my lower tax rate, but I still have the problem you mentioned about getting the money out once you've sold.
Yeah. So, I mean, I don't think there's any clear-cut solution because, you know, it's 6 of one here, half a dozen of the other. So it's a complete mixed bag, pros and cons for each.
I guess I would only add to that the timing of needing the money is going to be a big factor here. So if I can afford to put that money away for the long term, a company is going to give me more bang for my buck, I think, because if my plan is rental property, use the net rent profits to pay down my mortgage, and maybe at the end of the day sell the property and reinvest the proceeds. Doing that at all at 19% rather than paying up to 45% on the rental profits would allow me to pay that mortgage off quicker and redeploy the money more efficiently. So there are good tax reasons for doing things in a company if you think long term. But I guess equally there are some non-tax reasons why a company might not be so good. And certainly, if you're thinking that you or a family member are ever going to live in the property, a company can become really quite painful. Because at that point you have things like the ATED annual tax charge potentially coming into play, benefits in kind on occupation, and all sorts of nasty things.
Yeah.
So I think that forget any tax advantages. If you want to have the ability to occupy the property yourselves, direct ownership is probably the way to go.
Yeah, I agree. So I think really the ultimate conclusion is something that us as tax advisors always like to say: you need to take advice, and you know where to contact us. Have you got anything that you've been reading or seeing that might help me relieve my boredom?
Yes, I have. I know as a mother of a shortly to become teenager daughter, I have a really good film recommendation for you, which is
okay.
Enola Holmes. Enola Holmes is the younger sister of Sherlock Holmes in this film. It's a new release on Netflix. So it's based in Victorian London. It's really entertaining, good fun, but it has that slight, not overplayed, but there's a definite feminist message in there. But there's also a really nice mother-daughter relationship to enjoy there too. So Enola Holmes on Netflix, really worth a watch.
Do you know what? I'd love to, Andrew. Unfortunately, we don't have Netflix. So with that, I'm afraid, we'll come to an end today. As I said, do contact us with your feedback. We're contactable on rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com. We look forward to seeing you next.
See you next time. Bye.